the economy. So there are 4 phases to the business cycle. You have the early stage, which is really marked by high growth. You have the mid phase, which is peaking growth. The late stage, which is growth starts to slow, and it's often marked by inflation. And then you have recession. This is a slide by Fidelity that shows where the different economies of the world are in relation to the economic cycle. And you can see the United States is in late stage, moving towards a recession. There's a lot of debate on what causes a recession or whether we're in a recession or not. Hopefully it'll become more clear as we go through this. But this tends to be the cycle that we're looking at. And you can see that it's driven by government spending, but the Fed will print money to fund the government spending. That's number 2. That leads to inflation. So we saw that in 2021, it started. That leads to increasing interest rates. We saw interest rates go up by about 6,000% last year. It's really historic. Real wages tend to lag inflation. So real wages tend to be negative, meaning the cost of goods are going up faster than the cost of income. That leads to a reduction in purchasing power, which means that people are buying fewer units and they're willing to pay less per unit. And then that leads to reduced corporate profits. The companies aren't making as much money. Profits are their income minus their expenses. So to maintain profits, companies have a fiduciary responsibility to their shareholders. And so you'll see them cut back and economize. And one of the easiest ways to do that is corporate layoffs. So you'll see unemployment tend to go up. Growth, layoffs, reduction of profit, earnings for companies, that tends to be a pretty good definition of a recession. We saw the negative growth in Q1 and Q2 of last year, but we didn't see the layoffs or the reduction in company profits or economic demand overall. And then a recession tends to reduce inflation. And to get us out of a recession, the government will spend and the Fed will print. And so, as you'll see, you tend to go through that cycle. So I think you're going to start hearing the narrative shift from inflation to recession. What really drives all of this is government debt. And this is looking back since 2000 at 2 different numbers. One, most people are familiar with, which is the US federal government's debt, which is about approaching 31 trillion. And the number down here is the Federal Reserve's balance sheet. So you think about, where does the government get its money for the debt? Well, as many of you know, get it from foreign investors. Foreign companies will buy debt. American companies and individuals will buy it, and the government itself will buy it, and the Federal Reserve will buy it. The government and the Fed are distinct. The Fed is independent of the government. There's a relationship between the two, but the Fed is not a government agency. It's meant to be independent. So you can see this spike right here in the Fed's balance sheet, meaning they printed money, created money to fund the government debt up here. So the government can get money from one of 3 places. They can tax us, they can borrow from us, or they can print. Well, taxing and borrowing is just moving money from one pocket to another. It's not inflationary. It's not creating more money. So if you take it from one person, that reduces demand. If you give it to another, that increases demand. The net demand stays the same. It's the printing that's dangerous when it comes to inflation. And that's really what we saw. Now, I will say it was interesting back in 2009. I remember very clearly there was a lot of printing, but there was not much inflation, which is interesting. And the reason why, and a lot of people thought there was going to be a lot of inflation. The reason was because it did not go into people's pockets. So it went onto bank balance sheets to strengthen the banks in a financial system. And the banks didn't loan it out largely. And there was a lot of bankruptcies. So bankruptcies were deflationary, and printing money is inflationary. So deflation and inflation offset one another, and the money did not largely make it into the economy. Whereas here, it went directly into people's bank accounts and they spent it, which you'll see. And that is inflationary. This is a good example where sales can go up, but profits can go down. So inflation will cause an increase in the top line, but it's hard to maintain margins because the cost of goods goes up so much, and it's hard for companies to pass that along. So we're seeing more and more of that. This is what's called the yield curve. And it has been an incredible predictor of recessions. There's never been a recession without an inversion of the yield curve. And every time there's a recession, there's an inversion of the yield curve. What this is, if you look at it from a normal perspective, If you loan money on the short for a short period of time, you'll pay a low interest rate. And normally, the longer you borrow money out, the higher the interest rate you pay. That makes sense, right? Because if you're going to give somebody money for 10 years, you should be paid more than if you give it to them for 2 years. This is a normal yield curve. An inverted yield curve is when short-term rates are higher than long-term rates. This is what's called the inversion of the yield curve. And this is not normal, but it is normal before a recession. And the reason it happens is because what investors are saying is that we're very concerned about a recession. And so if we loan money out for a long period of time, what we think is going to happen is interest rates are going to drop. And if interest rates are going to drop, it's going to cause bond values to go up. And the longer you've loaned money out, the higher the bond value, the better the return you're going to get. And so investors demand a higher return in the short term and a lower return in the long term because they anticipate interest rates going up. And if that does happen, you'll make a lot more money owning a long-term bond. My philosophy right now on it is I don't really care about trying to make a lot of money on a bond. I just want a return of principal right now and interest. And we're making about 4.5% annualized for 3 to 6 months. So you just buy the bond, hold it to maturity, collect your interest, buy a new bond. It's a very, very safe and predictable way to get a reasonable rate of return. So this is a sign of a recession. You can see we got the recession here, we got it here. It's interesting that in 2019, we got an inversion of the yield curve, and then we had COVID. But I think there's good reason to believe that we would have gotten a recession even without COVID. And now look how deep this yield curve is. The deeper it is, the more concerning that is. So that's something to be aware of, pointing towards a recession. Also, if you look at consumers are running out of cash, and not only running out of cash, running out of opportunities for cash. If we look down here, you'll notice that people did not spend as much during COVID, and then there was a lot of government handouts. And so people really built up their savings during COVID. But then as the government handouts stopped and as the economy reopened, people have been depleting their savings, and now they're actually going negative. And so this is not evenly distributed, of course. Wealthier people still have savings, whereas poor people have been depleting their savings and depleting their credit card capacity. And so not only has savings gone negative, but now the credit cards are maxed out and delinquency rates are rising. That's an ominous sign for the future. So this is common. You can see before the 2009 recession, we were at these levels. So another sign that maybe it's good to be a little more defensive going forward. That this is just telling a similar story. People are looking for cash. They got used to spending, and then government payments stop, but it's hard to stop the spending. And then you have inflation. So people are having to pay more for goods. It causes a lot of pressure. And so credit cards is one place to get extra money. 401ks are another place. So hardship withdrawals from 401ks are, you can see they're at historic levels right now. It's not a huge percentage, 0.5%, but you can see that it's kind of on its way up. So who knows how high it'll go, but it's not good to see that rising. And then another negative indicator is manufacturing PMI. When it goes below 50, that's a recessionary sign. That means that manufacturing is slowing down. So you can see that it's been headed down. How far it goes, who knows? It won't go down forever. It'll hit a certain level and it'll start coming back up. But it tends to be a leading indicator of the economy. So whereas unemployment is a lagging indicator, that's kind of like the last ditch effort for companies. And so when there's high unemployment, that doesn't mean the economy is necessarily going to get worse. Maybe it's a sign that's actually going to get better because it's a lagging indicator. And speaking of the labor force, you can see that there was massive layoffs and employment. This is total employment. It has been growing. And it's gotten to roughly where it was pre-pandemic, but there's still a pretty significant gap to where it would have been otherwise. So there's 4 million workers missing right now. And you can see that the people coming into the workforce, it's not as fast as the trend line had been. These things happen. This really accelerated a lot of things and made it happen very, very quickly. You can see that it came down during the great financial crisis. And even in the 2000s, it came down. So there's a lot behind this, but you can tell, like when you're in a restaurant or just getting service, that there's a lot of people missing, and that's part of it.